Welcome back into the Money and Velli podcast. I'm your co-host Velli, and today I'm going to be going over exactly what are options. So let's get straight into it. Now, before we do, I want to give a quick shout out to Tony B for just taking the time out of his day to come do an interview with us on the Money and Velli podcast. Now, if you don't know what we're talking about or who he is, you can go check it out on our previous episode, Tony B interview. Again, he took time out of his day to come and have an interview with us. He dropped a lot of jewels, gave a lot of information, and especially a lot of motivation for up and coming people or people on their grind or even people that's already in this game. He dropped a lot of information, gave a lot of motivation. So if you want to see more, check him out, or you can either look him up. It's Tony B. Just had to give a quick shout out to him. So let's get, of course, back into this. We're going to talk about option trading. Now, I know I've discussed this in previous episodes of the podcast, but I'm going to give, I wouldn't say a refresher, but I'm going to dive just a tad bit more into it. Now, I would rather you start investing, but maybe passive investing, not for everything, not for everybody. So here's the other option. No pun intended. Option trading. Again, I would rather you do passive investing because this is a little bit more riskier. And if you're just starting out, you don't know what you're doing. But at the same time, if there's information, I will present the information to you. And this is what I do. I do option trading. So let's dive on into it. What are option contracts? Now, when we see these slides, all these paragraphs, definitions, information, all of that is from Investopedia. I'm just giving you their definition and then I'm going to break it down to my own understanding and how I define it myself, and essentially just break it to the lowest common denominator possible. So, an option contract is an agreement between two parties to facilitate a potential transaction on an underlying security at a preset price, referred to as the strike price, prior to or on the expiration date. Now, the first part is kind of speaks for itself. A contract is an agreement between two parties. Most of us know that and understand that, but it's concerning the underlying security or underlying asset. In which case, this is coming from me being in the stock market. They're talking about the stocks, one of the companies, whether it be Apple, Twitter, Tesla, Verizon, Visa, um, any of those would be an underlying asset or the underlying security. And it's a transaction on the security at a preset price, referred to as the strike price. I could get into it a little later, which I probably am, but say I'm shooting for that Verizon's going to be, I say Verizon's going to be at like $60 or 70, and I set the strike price for, eh, we could say 60. We'll just say 60. We'll set the strike price at 60. Now, it does have an expiration date. Option contracts have an expiration date. So you can only purchase this contract or even facilitate this contract before the expiration date, either on the expiration date. You can't do it after. That doesn't make any sense to do it after. That's like there's a basketball game between the Lakers and Celtics. Now, say this game already happened and the Lakers won, and a week later, hey, I'm gonna bet you $50 that the Lakers are going to win this game. That makes no sense. The game already happened a week ago. There's no point in betting on anything. It already happened. So it's the same thing. It'll just be stupid to do. So let's go to the next one. Types of option contracts. There are two types of option contracts. You have puts and you have calls. Both can be purchased to speculate on the direction of the security or hedge exposure. They can also be sold to generate income. Essentially, what a call is, you're betting that the underlying asset, or in this case, the company, the stock, is going to go up. That's what a call is. A put is essentially you're betting that the underlying asset or stock will go down in price. That's all both of them are. A call, I'm betting that the underlying asset will go up in price. A put, I'm betting that the underlying asset will go down in price. That's all it is. Now, potentially, not even potentially, you can exercise these contracts. And I'll get into a little later what exercising is. And you can either exercise them, the contracts, or you can sell the contracts. Now, when you purchase a contract, you have the right, but you're not obligated to purchase this contract. Remember that you have the right, but you're not obligated to purchase this contract. Now, when I say exercise, within a contract, there's 100 shares. Each contract has 100 shares. Potentially, let's go with SPY. Let's say SPY is trading at $380. I'm going to place a call because I think the chart looking right. I'm getting all the information. I have good market contacts, or I have good market contacts. Doing my technical analysis as well as fundamental analysis, everything looks right, and I'm placing a call. E- Essentially, I'm betting that it will go up in price. Now, remember, it's trading at whatever price I said. I guess I said 360. SPY is trading at 360. I think it's going to go up in price. So I'll put the strike price at it'll at least hit 370 or higher. My strike price is 370. As long as it get there, I've made a successful trade. That's the strike price where I want it to be, the 370 range. Now there's more um nuances upon that concerning the strike price, but I'm not gonna get into that. We'll get into that on a later date. But exercising is, remember, there's 100 shares within this contract. Essentially, I'm purchasing this contract saying that I want to buy stock XYZ, or in this case, SPY, for a certain amount of money at a certain price. If everything goes correctly and my bet was right, I can exercise that contract, or better yet, I can execute the contract. Because say SPY shoots up past 370, it shoots up to like $410, just for the circumstance concerning this conversation. Let's just say it went up to like $410. Now remember, my strike price was 370. Now, even though that stock is worth $410, the contract stated that I can exercise to buy this contract at $370. I can do that. That's exercising the contract. But then again, that 370 number is wrong because that's just the strike price. Remember, there's 100 shares within a contract. So usually there's a number right beside it to tell you how much that contract is truly worth if you exercised it. So that's just something to think about. Let's go on to the next thing. But that's literally exercising. It's just executing that actual contract saying I will buy these shares at this price. Because remember, you have the right, but you're not obligated to buy this contract. But if you do so decide to buy this contract, you would execute it or exercise it. My bad. And general call options can be purchased as a leveraged bet on the appreciation of a stock or index, while put options are purchased to profit from price declines. The buyer of a call option has the right but not the obligation to buy the number of shares covered in the contract at the strike price. Put buyers, on the other hand, have the right but not the obligation to sell the shares at the strike price specified in the contract. Now, this basically covered everything I just said. I kind of did a breakdown way ahead of time. Oh well. We'll just skip to the next one then. Now, example. exactly how an option contract works. Eh, I really don't feel like reading all this. So let me give you a little bit of an easier example. We'll do a call. Say you're looking to buy a house. You want to purchase a house or purchase some land, whatever the case may be. You found this guy and he's selling his property. And he knows pretty nice property. And say he's selling it for, we'll say 500,000. And you go in your head, you're assuming, or more so, you know that the price of this land or this property is worth more than that. But he doesn't know it, the one selling you the land. But he has to go to somebody to figure out how much it cost. But he's still assuming it costs around 500,000. And he's like, you know what? I'm gonna go to the realtor or whoever to figure out how much this piece of land is worth. And but no, for right now, I'm gonna sell it to you for 500,000. And he's like, you know what? Let's make a bet. Before you go to the realtor, I will give you a down payment or a premium of $20,000. This is just to call me first when you figure out the price of how much your property is. Before you call anybody else, call me first and let me know how much the price of this house is you're selling. But that $20,000 I gave you, when you find out how much the house is worth, I still want to buy it at $500,000, regardless of how much it actually is worth. Of how much it actually is worth, I will buy from you at $500,000. So I'm giving you a $20,000 down payment just to think of me first before you call anybody else when you figure out the price. Now, a week or so later, and to add on to that, when he calls him first, he could say, and give me like a week to think about it when you figure out how much your house is worth or how much your property is worth. So he goes to the realtor, whoever the case is, figures out how much his land is actually worth, and say it's actually worth like $2 million. It's for the sake of the conversation. I know it's exaggerated prices sometimes, but just say it's worth $2 million. He goes, no, oh wow, my house is worth $2 million. I'm gonna hurry up and sell it. Before he can even finish there, remember, he got paid a deposit or a premium of $20,000 to call up you first before he calls anybody else. That's what the $20,000 for. So now he has to call you. 'Cause remember, you said you would buy it at 500,000. You made a bet regardless of what the price may be in the future. I will buy it from you for 500,000, or at least give me the right to buy it for $500,000. So he calls you up. He tells you the price. Oh, well, of course, you're going to exercise the contract and purchase the house for $500,000. Now, technically, it'll be 520,000 because you gave him a $20,000 deposit or premium. But hey, that works out because the house is actually worth 2 million. So you could turn around and sell it and still make a profit, or you can do the other thing instead of exercising it. You do what I do. You can sell that contract to somebody else and make your money back without dealing with the hassle of the house and other things. That's my understanding and my kind of example of option trade. It's kind of the same thing. You purchase a contract, you purchase it at a certain strike price, and you have a certain day to either exercise it or sell this contract. You can't sell it after that specified date. These are what option contracts are. Now, it's extremely easy to lose a lot of money within this game. 'Cause remember, essentially, you're betting. So some people might take it a little far. A lot of people do. Even if you don't take it far, it's a lot to learn within this. It's a very risky game. Remember when I said high risk, high reward? Yes, you can get a high reward, but there's a lot of risk involved on this plate. A lot of risk involved on this plate. So be careful. Do your research. Get information, study, do everything. Back test your strategies, back test old plays, old things that happen within any of the stocks. Only trade with a few stocks so you can okay, each stock has kind of like I kind of want to say their own personality, they have their own nuances. They some act different from others. When you trade on one company, you'll start learning its habits. Now the habits aren't consistent, but it's a certain way that it moves. You will understand it if you stick and trade with that one stock. So again, back to strategy, do your research, investigate, learn from other people, talk to other people, do everything you can to save yourself from drowning in that hole or getting hit with something terrible. Practice, research, investigate, and backtest. Now, again, let's go back to some of the key takeaways from this. Remember, an option contract is just the right, but you're not obligated to buy a contract. There's two types of options. You have calls and you have puts. Essentially, with a call, you're betting that the underlying asset or stock will go up in price. With a put, you're betting that the underlying asset will go down in price. Now, remember, these contracts have an expiration date and they have a certain price depending on what strike price you want or strike price you look at. Now, there's certain other things that goes on with that. Maybe I'll get into that on another video. But remember that. Another thing I didn't add on here, I said it before. When you look at the option contract and it says like $1.78, that does not mean that that entire contract is worth $1.78. It is saying, remember, a contract has 100 shares. It is saying that each share is worth $1.78. If you do the math, there's 100 shares within that contract. Each share is $1.78. You multiply 100 times $1.78, you'll get $178. That's what that $1.78 or 58 cents means. Just remove the decimal, you'll get the actual price. So for right now, I think that's it for this. I won't even say demonstration, more of an overview exactly what option trading is and exactly what I do. I hope this little information helped you, gave you a better understanding of the whole scenario. If you have any questions, go ahead and ask. You can put them in the comments. Maybe I'll go over this again just to kind of drive in more details, which I probably will on a later date. But make sure y'all like, comment, subscribe, and I'll catch y'all next time. So, peace.